For those of you who don't know me, my name is Nick Gate. I am investment director here at Tideway Investment Partners. One of my roles as investment director is to head up fund selection and appoint managers which fit within our asset allocation framework. We have with me here today one of those managers, Jack Holmes from Artemis Investment Management, part of the Edinburgh fixed income team. Jack co-manages Artemis's global high-yield bond strategies, as well as Artemis's high-income strategy. Jack's previous ventures were at Holmes Capital, where he co-managed a range of high-yield bond funds and was also involved in their strategic bond strategy. And prior to that, he was also an analyst at Standard Life Investments. So, Jack, hopefully I've done you justice there and not missed anything out. And thank you for taking the time today. I have been assured that from your fellow team members that you are the most passionate about high yield in the team. So, glad we have the A team with us here today. So, for investors who aren't too familiar with the high yield market and the strategy in general, if you could just take a few moments to outline both of those, that'd be great.
Yeah, so the high yield market is fundamentally about lending to companies over relatively short time periods and basically transforming that short-term corporate profitability into income for investors. So really, the strategies are focused on having very good bottom-up analysis of those individual companies to understand the credit risks to them and effectively understand how likely we are to receive the income that we're theoretically being promised. So that's where we focus on. In terms of the individual strategies, we run a global high yield fund, which is focusing, as the name suggests, globally on the high yield market, and a short-dated global high yield fund, which is doing exactly the same thing, but purely focusing on the very shorter end of the market. So basically bonds with less than 5.5 years to maturity. We believe that that's a lower volatility way of approaching the high yield market. Again, still attracting some very attractive income in our opinion, but just with a slightly lower volatility compared to the all maturity version.
Understood. No, thank you for that. High yield has been in the press quite a lot over the last few years, and it seems to always be negative. As I said, you're passionate about high yield. What would you say in defense to these negative press articles?
Yeah, I mean, it's a really interesting one. And to be honest, it's one that I've spent a long time scratching my head over. I think a lot of people look at high yield as being a very, very risky asset class. And especially over the last few years, an asset class that doesn't actually have high enough yields to justify that risk. I would argue very strongly against both of those points. On the former point around the level of risk, I mean, if you look at high yield versus, say, equities, what we've seen over and over again is high yield exhibits lower volatility than equities. And importantly, in big drawdowns like the global financial crisis, like the dot-com bust, actually high yield significantly outperformed equities during those periods. So I would very strongly push back against that assumption that high yield is a fundamentally higher risk asset class. And in terms of the reward side of it, I mean, it is undoubtedly the case that yields have been, in a historical context, relatively low over the last few years. But I think today is a really interesting point to look at the market because as of today, high yield is offering yields in the very high single digits. And actually, if you look historically, yield has been the best predictor of kind of longer term returns. And those long term returns in high yield have been very, very attractive historically. So I think it's a really interesting time to look at high yield. But certainly if I kind of look at the assumption of frankly, a lot of investors and certainly a lot of the media is around high yield being this kind of pariah asset class, an asset class that always is carrying this huge amount of risk. But fundamentally, from my perspective, that kind of lack of popularity of high yield means that it's almost always a good place to allocate capital, at least some of your capital, because frankly, there's very little danger of it ever being overrun because everybody is always so negative on the asset class. So from my perspective, I'm a bit of contrarian naturally. It always appeals to me from that perspective. And frankly, I think from those investors who are willing to kind of take a deeper look at the asset class, I think it offers, particularly today, some really, really interesting opportunities.
Yeah, on that note, where spreads are where they're at, obviously, I think you've mentioned it's been cheaper than it has been in a fair while. Do you think that's a reflection of the possibility of increased default rates in the market, or do you think that the market is fundamentally mispricing what's currently out there?
Yeah, I mean, I think defaults are going to rise because they've been at very, very low levels over the last 12 months, kind of unsustainably low levels. So they will rise. But I think what's important is to consider what's being priced in by the market today. And at the kind of yield levels we're seeing, we're talking about the kind of pricing of effectively a global financial crisis, a very, very significant default cycle, and high yield still producing a positive total return over a longer time period. So yes, defaults will increase, but it's really important to say that yields have significantly increased. So yields today relative to the start of the year are double what they were. So today you can effectively get very well protected from those defaults by effectively just buying those high yielding assets, which are going to yes, they are going to suffer some defaults, but there is going to be this significant kind of wave of income that's coming into you that will more than offset that level of defaults coming through.
Yeah, perfect. And obviously, as an active manager, you are looking for those securities which are not going to default, or hopefully not default. Obviously, you buy a range of credit qualities, so I mean, you can't guarantee that's always not going to be the case. But yeah, can you just highlight briefly some of the things that you do in order to avoid those defaults, which might be seen in the wider high yield market?
Yeah, so I'll touch on two major ones. I mean, ultimately, what we spend our day doing is we run very high conviction portfolios, so they're quite concentrated portfolios, which means that we can focus on that bottom-up analysis to identify those securities that we believe have the greatest possible chance of paying us back. So that is what we spend our day doing on a very kind of granular basis every day. But the two big areas that I would highlight at the moment are the triple C part of the market and emerging markets, particularly China, particularly Chinese property. So if I talk about the triple C part of the market, so to explain the high yield market, high yield securities are, and these are credit ratings, so Standard & Poor's, Moody's, Fitch, basically from double B, which is the highest quality part of the high yield market, down to triple C, which is the lowest quality part. And if you look historically, triple C's account for about 10% of the market, but they've accounted for roughly 50% of historic defaults. So effectively, a very small part of the market that accounts for basically half of defaults historically. So that is the area that, from our perspective, carries the highest fundamental risk of defaults. And that is an area that within the short dated high yield fund, we have very little exposure to. Within the global high yield fund, we do have a bit more exposure, but it's still in the mid-single digits. So it's not a very significant exposure to that. And where we do invest in that area, frankly, it tends to be because we believe that the company has been fundamentally misrated rather than because we believe it's fundamentally a triple C security. And the other part that I mentioned was emerging markets. Now, I've said that we are global funds, and we are global funds, but we do focus on developed market high yield. The reason for that is basically because, from our perspective, high yield is effectively a contract that we have with a company. We have said, here's an investment, and in return for us taking X amount of yield of interest over the coming years, we're going to provide a level of downside protection for us as investors. And that's very important when you're looking at a high yield bond, is that consideration of downside protection. What we've seen over and over again is in emerging market high yield, that downside protection in that contract, when push comes to shove, isn't actually worth that much. Now, you can absolutely make money from emerging market high yield. I'm not saying that you can't, but from a fundamental risk perspective, it is a higher risk asset class. And frankly, it requires a different way to approach that market relative to what we spend our days focusing on. So we tend to avoid that part of the market. At the moment, I think one of the areas with the highest potential chance of default is Chinese property, which makes up a significant part of the high yield market globally. That is an area where, frankly, we've seen a huge influx of capital over the last decade into it. A lot of that capital hasn't, I would argue, been allocated very intelligently. And at the same time, you have the Chinese government basically wanting to rein in speculation in that part of the market. That is, for a high yield investor, a very nasty environment to be allocating capital to. So if we're kind of looking at over the next, say, 24 months, that's an area that I think will suffer some quite significant defaults, and it's an area that we have no exposure, nor have we had any exposure to for since the funds were launched. So I think those are the two real areas of differentiation from a kind of top-down perspective. But ultimately, the big driver of of our default experience is going to be our bottom-up credit analysis. And historically, we have experienced considerably less defaults than the wider market going through those default cycles.
On that theme, then, you've mentioned you are a primarily bottom-up security selecting strategy, but you do consider macroeconomic effects in there. Can you just discuss? Obviously, you're obviously avoiding emerging markets right now, in China in particular, as you've just said. How has the sector composition of the fund changed over the last 18 months? What areas are you now seeing the best opportunity, or no opportunities essentially?
Yeah, I think that there's kind of three main areas of differentiation, and this is again primarily driven through bottom-up analysis. But we always have to have this consideration of, okay, we could pick the 30 names that we find the most attractive in the high yield market, but if they're all pointing in exactly the same direction, there's no diversification across the fund. So there always has to be a consideration of the top down in there. But where we're seeing the most attractive opportunities and kind of the biggest, if you like, contrarian bets relative to the wider market, one of the areas that we're most bullish on is the auto space. So whether that's auto manufacturers in terms of the end producer of cars, or whether that's the auto parts supply chain, we are very bullish on that space. We think that it's an area that has been punished significantly over the last, say, 18 months in high yield.
Mm-hmm.
And there were a lot of concerns about chip shortages. That now seems to be easing off, but a lot of concerns about going into a recession, what do these companies look like, all of that kind of worry. But we fundamentally believe that the auto space is actually far more resilient than people are giving it credit for from a demand perspective. There's a lot of people who have been trying to buy a car for the last 18 months and haven't been able to. So we do think that has quite significant consistency to it. But the other important thing is the structural change in that industry. So whereas most people use their point of reference, the failure of Ford and GM in the run-up to the financial crisis, fundamentally the market was an incredibly different marketplace then. Margins were lower, leverage in terms of the indebtedness of companies was much, much higher. And frankly, the supply chain it wasn't really very well formulated in terms of companies actually holding a reasonable share of the value chain. We think those have fundamentally changed today, and frankly, the market has ignored all of those positive the positive momentum that you've seen there. So that's an area that we're very bullish on. That's our largest kind of relative overweight. In terms of an area that we're less bullish on is telecoms, and again, that's a real differentiator from most of our peers. It's a big part of the high yield market, but the telecoms industry is one where we've seen very, very high levels and increasing levels of capex requirements, of companies having to invest, purely basically running to stand still, where they need to invest, they need to get 3G, and then they need to get 4G, and now they need to get 5G. And basically, there's no additional kind of pricing benefit that comes to them from that. It's just what they need to do to continue to compete in the market. So at the same time, you've had less pricing power. You've also had increased capex requirements, and you've seen that come through on balance sheets. So indebtedness has increased, and frankly, some of the multiples in terms of the equity market that those businesses trade on has decreased. So we think that's an area where a lot of investors have regarded it as a bit of a safe haven over the last 10 years because it was a place where it was relatively less cyclical than other parts of the market. But actually, I think a lot of those are missing the bigger picture, which is the structural decline in creditworthiness of a lot of those issuers. So that's a big underweight that we have in both of our funds. And the one final thing that I touch on is the energy space. Now, energy is a very big sector in high yield. It's the biggest sector in high yield. That has caused issues in the past, as 2015 showed. But what we have quite a differentiated approach, which is basically we don't invest in US energy. We invest significantly in European energy, though. And there are basically three major reasons for that. One is that lifting costs in terms of the cost of producing a barrel of oil in these European producers relative to US producers is less than half. So we think it's fundamentally much more resilient from a cash flow perspective to invest in European energy than US energy. But in addition to that, European energy has significantly lower levels of indebtedness. And in addition to that, from an ESG perspective, actually, we believe that European energy is much further along the curve in terms of adapting to the regulatory environment that comes along with that. So those three factors have combined to kind of leave us with this big exposure to European energy, but no exposure to US energy, which is effectively the complete inverse of where most global high yield investors look at. Most of them will focus exclusively on US energy and not have any investments on the European side. So that's a big differentiator for us. And frankly, from our perspective, we run high conviction funds. We want them to be very differentiated. We want to do things that other people aren't doing, because if other people are following what the index is doing and what the broader market is doing, that creates huge opportunities for us as people who are able to back our conviction whenever we find companies or securities that we find really interesting.
Yeah, that is very interesting. No, thank you for that. Just on the final topic associated with credit risk. Obviously, no manager is perfect in their security selection. Would you mind just outlining the process you go through, with regards to your sell discipline, if there's something you're not happy with, or if there is a negative earnings report which you weren't expecting, or a downgrade, how you deal with that?
Yeah, I mean, it's one of the parts of having a high conviction portfolio is effectively none of the positions there are stale. We're continuously evaluating those positions because each of them needs to justify their place in the portfolio. If it doesn't, we just sell it. And there's none of that kind of ballast in the portfolio or anything like that. There's nothing that we're looking to just have in order to kind of have a neutral weight to index or anything like that. So it's a very strict discipline around everything within the portfolios needs to justify its place. But obviously we do get things wrong. That happens to everyone. And especially it's been an interesting 3 years. So the two funds have been at Artemis. We did run identical strategies as the previous shop, but at Artemis, it's been an eventful 3 years, which have tested a lot of those assumptions. And frankly, I think having a formulaic sell discipline is slightly counterproductive, because there are different situations, and high yield is not an efficient market. So a bond can fall 30 points for very little reason at all. And equally, a bond can not fall 30 points whenever it really should have fallen 30 points. So we can't allow the market and what's happening in the market to drive our process. But what we need to do is, whenever there is something that changes, be that a price move or be that fundamentals moving, we need to reevaluate that position, and we need to say, does this continue to justify its place? And there are positions that have dropped to 40 cents on the dollar, and we've topped those positions up because we believe that fundamentally they're wrong. And equally, there are positions that have dropped 40 cents on the dollar, and we've said, no, actually the downside risk is still greater than this, and therefore we need to sell this position. So I think it's important to not just have a formula that we follow kind of blindly to do that, but it is very, very important to be honest with yourself and say, look, am I holding this position purely because I thought it was great value at 90 cents, and now the story has changed, and now I need to accept that, this isn't about my ego, this is just about what is in the best interest of the fund. And I think that is a very, very important thing. But frankly, I think it's much easier in a portfolio which is running relatively concentrated and is having this constant dialogue around, does this position justify its place, than a portfolio that frankly has 500 names in it, and whether you sell or don't sell one of those, frankly, doesn't make much difference to your overall exposure.
No, perfect. No, thank you very much. Moving on then, obviously, we discussed earlier that high yield had quite negative press at the moment, and I suppose one of those negative features which people associate with fixed income securities is obviously it's quite susceptible in a rising yield environment, rising interest rate environment. Can you discuss, with regards to the short dated fund in particular, how the fund is able to protect against rates?
Yeah, so the short dated fund is, as the name would suggest, it's focusing on the shorter end of the market, which tends to mean that it has much less sensitivity to interest rate changes than a fund which is focusing on the entire market or is focusing on the longer end of the market. But more alongside that, frankly, within high yield, the yields that you're receiving are far more related to corporate profitability and corporate risk than to government bond risk or interest rate risk. Because the reality is, and as of the end of June, to give some kind of context on this, the short-dated high yield fund, and this is hedged into sterling, so there's no currency risk here or anything like that. I think it's important to state that up front. The short-dated fund was yielding 8.6%. Now, yes, inflation is very high today. Personally, I think inflation will remain. It will be quite sticky, but I do think we are seeing the highs of inflation today, and it will trend down. Frankly, there aren't that many asset classes in the world that will pay you in a very short duration, a short-dated fashion, that kind of levels of yield in an inflationary environment. And that is fundamentally the big defense to the high-yield market, I mean, in this kind of structure. I think the other thing to mention is that short-dated strategy, because it is focusing on the shorter end of the market, as bonds move closer to maturity and to being taken out, there's this huge wave of capital which is being invested back in the market. So yes, we may invest in a security that yields, say, 6%, and it's got 1 year left to maturity. But then that means that effectively we're going to get 6% plus the principal that we initially invested to invest in a year's time. And that means we can constantly adjust these higher interest rate environments without having that exposure that comes from, say, having a 30-year bond, and then you have to wait for 30 years to get your principal back and reinvest it at those higher yields. That isn't what's going on in particularly the short-dated fund, because what we're doing is we're constantly reinvesting that capital, and that basically provides its own insulation and its own benefit from whenever yields increase, because we're constantly reinvesting at those higher yields. So it is something that, I mean, fundamentally, these are fixed income funds, so there will always be a level of exposure here, but frankly, relative to the whole fixed income market, this is not the significant driver of the asset class. In actual fact, it's probably the best insulated part of fixed income, particularly in terms of the short-dated fund, to weather that kind of storm.
Understood. And yeah, if you wouldn't mind commenting on the liquidity profile of the fund. Obviously, you mentioned bonds are maturing in swathes over the short term. But yeah, how liquid is the market at the short end compared to, I don't know, 5-6 years out, the longer end of the curve?
Yeah, I mean, liquidity has got worse over the course of this year, but it's important to put that in some context. We have found no issues whatsoever trading in terms of the securities that we're looking to buy and sell. The strategies are quite active in terms of whether that be in the short-dated fund in terms of reinvesting those proceeds that are constantly being provided, or in the all-maturity fund in terms of selling one position and buying another. They're all quite active strategies. So we are actively engaging with the market on a pretty much a daily basis. And there's been no issue in terms of getting capital invested and in the all-maturity fund in terms of selling positions to buy positions. But it definitely has worsened over the course of this year. Now, part of that is, the natural instinct in terms of just a year that has been tough for market participants overall. I think there's an instinct to kind of shut down and not want to do too much and kind of just hold still as far as you can. So I think there's an element of that, but also I think it's important to say, we're at the end of July. This is not a time that is generally that good for market liquidity, whether that's fixed income, frankly, or equity liquidity, because lots of people have gone on holiday and they're not going to be trading things very actively. So it has got a little bit worse, but again, within the context of what we're doing, it's absolutely fine for us to continue to follow our process and to ultimately deliver performance.
No, perfect. Yeah, with regards to you've stressed very heavily that this is an active fund and in no way constrained by what's contained within benchmarks. Yeah, I think as part of your literature, you own multiple securities which do not all have a very, very small weighting in the benchmark. Could you just basically provide an opinion on the shortcomings of if you believe the shortcomings of a passive product, what the shortcomings of a passive product are versus this active strategy?
It's a really interesting question because, look, I understand lots of investors are considering passive strategies, and that's something that we have to be aware of and we have to consider. And frankly, from a market perspective, it has big impacts upon what goes on in the high yield market. So we have to be aware of it from a kind of alpha perspective as well. What I'd highlight about ETFs within fixed income, particularly, and these are particularly acute within high yield, is ETFs within, passive strategies within, say, equities. Fundamentally, if a company grows its top line, grows its bottom line, it's rewarded with a bigger market cap, it becomes a bigger part of the index. That kind of rewarding of good behavior is, and we can argue about it all day long as to whether the ultimate outcome is right, but that seems like the right progression. Within fixed income, particularly within high yield, it's exactly the opposite approach. So basically, the only way you grow as part of a high yield index is by issuing more debt. And frankly, as a lender, I don't want you to issue more debt. I want you to repay the debt you already have. And therefore, that dynamic is really, I think, sits at the core of why I have a fundamental issue with both high yield indices, but also the ETFs that are derived off them. So that is a major issue. But frankly, from an alpha perspective, that's great, because if it means that other managers are kind of somewhat blindly following these indices, either because they're kind of explicitly passive strategies or because they're effectively passive strategies, that produces a lot of opportunities for me to outperform in that kind of environment. Produce a lot of flows that, frankly, are not intelligent and therefore create inefficiencies within the market that I can exploit. So I don't have any fundamental issue from a market perspective, but I don't think it's the best way to allocate capital by a very, very long shot. I think the other thing to highlight within high yield particularly is you see, and we've seen this over and over again, if you look at the sectors that have grown in the high yield market, they're almost always running up to a point where there's a bust and then there's huge capital losses. So like whether it's the dot-com bubble and the growth in TMT up until that point, whether it's the energy bust and the growth in US shale before 2015, or indeed today, whether it's the growth in Chinese property up until today, these are all problem sectors. And you could have really identified them beforehand by just saying, okay, well, what's really growing in the high yield market? That's probably going to be a problem sector. So I don't want to allocate capital in that way. I want to be better in terms of actually saying, I don't want to kind of blindly go into a problem sector and hope that I'm just marginally better at picking the least worst companies within that. Why would I own any of that sector if I know it's a problem sector coming out? So that's, I think, a very important point to highlight is there is nothing efficient about high yield indices. In actual fact, from an investor perspective, I think there's a lot of inefficiency that comes from them. The other thing to highlight, again, from a high yield perspective, is they're not actually cheaper. Like from a fees perspective, they're not particularly cheap. We're not talking about S&P trackers or anything like that. These are quite expensive products. So from that perspective, I have quite strong views on this, but I do think that investors are better served by buying a good active product in high yield than by buying a frankly middling to bad ETF.
No, perfect. Very comprehensive answer there. It's a lot to take away. I think, just one final question, if I may, taken up enough of your time. But I don't think any interview would be complete these days without discussing ESG. I noticed that you have made slight changes to your mandate. I'm not sure when it was, in the last 12, 18 months. Can you discuss briefly what those changes were and the rationale for those?
Yeah, absolutely. So we decided to basically formalize some of what we have always done around our ESG process. And I think it's important to highlight we do have an ESG process. We have always had an ESG process. But it's important to highlight this is not about us feeling good about ourselves or frankly about clients feeling good. This is about us producing better investment returns. That is the reason why we're doing it. Mm-hmm. We believe that ESG provides a lens through which we can better understand risks. And frankly, within high yield, risks are the more important thing to understand for us in our investment process. So that's why we implement ESG. We have been doing it since the fund's launch, and we did it at our previous shop as well. So it isn't a new process or anything like that. What it is simply formalizing that previous process and basically making it a bit clearer to investors that these are the things that we're going to be focusing on. But from that perspective, it's not a significant change in process or anything like that. It's really, and that process is around, we have a phrase, it's about economics, not ethics. So what we're doing is we're looking to improve investment performance through this. We're not looking to feel good.
relatively hidden in your investment literature there. So it's good to highlight for our clients that these ESG considerations are integrated into the portfolio. But no, as alluded to, that's all from me, Jack. Thank you very much for taking the time this morning, and have a good rest of your day.
Yeah, thank you very much.